Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we're taking a look at Tyson's earnings. They came out, the stock went up, it went down. It's a mixed bag with these earnings. And the headline doesn't seem too bad, but when you actually start digging into it, they're still working on that turnaround. So we see sales up 0.4% over the prior year, so essentially flat. Operating income down 51%. Earnings per share down 66%. And that's a lot of things that are down. And that is why the market decided that it wanted to punish the stock. Prior to earnings, the stock ran from 52 to 58. And now it's back down to. There was a lot baked into these earnings, and the market didn't exactly get what it was looking. Now, this is the start of the new year. They're very highly dependent on meats. So essentially, they're a cyclical commodity stock. But when we look at the summary page, I have everything updated through last year and the expectations for this year. And so this is what we'd be looking at. Fair value right around $50. I know I bought 100 shares at 48. I'm sitting okay on that. I was hoping for a faster turnaround, but it looks like this is going to take a little bit longer than expected. We'd want to reevaluate right around the level that it currently sits. And the actuals, 54.34 right now. It's been as high as 63.49 in the last 52 weeks and as low as 45. Earnings yield, a little low. They need to come in with EPS of at least 272. They're expected to come in 214 this year, 342 next. Cash flow yield, they had negative cash flow this last year. Traditionally, they're around 3%, which is a little low. Dividend yield, higher than it's usually been. That's because the stock price is down, and it looks like if they continue with this rut that they're in, they're not going to be able to afford that dividend for too long. ROE looks good. Makes us question the debt. The debt's okay. It could be better, right around 1. That's the minimum that we like to see. ROI, not really good, 5.5%. So their investments don't pay off very well, and their assets lose the money. Profits, their margins are currently half the gross margin of what they've traditionally seen, less than half of what they've traditionally seen, and their net margin was negative, traditionally right around 4%. So they do have really low margins. That's why this is the kind of stock where they're essentially cyclical commodity with low margins. Definitely not a buy and hold forever type of stock, more of a invest for value on the turnaround and collect a bit of a dividend along the way. Revenue has been growing, but slowing. Analysts are only projecting 1% growth over the next 2 years, so we're using that for our thesis now. Earnings per share growth, they're expecting a lot going forward. There's a lot of room for them to make up. Over the past few years, they've come in around $9 2021, $9.18 2022, and then a dip in 2023 to $1.34. So even getting up to 3, that's 60% per year, doesn't get them to where they started. So they could grow faster if they're able to fix those margins. And it seems mostly like a margin and expense issue here with this company because their revenues were growing pretty quick over the last 2 years. That's what we like to see. Slowing way down. But if they're able to control those expenses, fix those margins, then they can bring earnings per share growth. Cash flow has been on the decline. If we just go look at it graphed, you can see it here. Not a good graph for cash flow. Cash flow is a very important metric for a company. So that's another thing where they need to fix their operations. And they seem to understand that and want to, but this quarter didn't really show that happening. Assets were shrinking just barely. Now they're growing them. I don't really like to see that if they have a negative return on assets, but maybe they can turn that around. Liabilities, constantly shrinking those. That is nice to see. Dividend growth, they have been pretty good at growing that dividend, but like I said, if they continue on how they're going right now in this rut, they can't afford that dividend. So this is the thesis we're coming up with. Essentially, either the average or midpoint of all the numbers that we've seen over the past few years. And this seems very high, $103 in 3 years, but that is assuming that they can get back up to those margins that we've seen in the past, that 4% net and that 11% gross. Using those, we get this. In 3 years, if they're able to turn stuff around, get those margins back in line, grow revenues at just 1%, and continue on as they have previously, you'd be looking at doubling your position. Profit of $60, share price of 103. In 5 years, it'd be 112, profit of 72.5 or 146%. And the average return each year going forward would then be $3.58. I had my eye on this one back in late 2022, early 2023, where we saw this huge dip. The fair value dropped from 110 to 40. And I thought it might be a turnaround arbitrage. It's not exactly proven to be that just yet. I mean, I am up on my position a few $100s, but there is a ways to go to get up to where the stock has been previously performing. Back in the day, 2020, 2021, 2022, $100 was a completely reasonable price for the stock. In 2021, we saw it trading at the end of the year at $87. And the fact that it's half of that right now is putting it on a lot of people's radars. I've seen a lot of articles asking if it's worth buying now that it's down at this price. I mean, I wouldn't buy a stock for 4% returns, but if they can prove that they have the turnaround in them and they're able to grow those margins, then looking at that $100 level again, there's a lot of upside here. So I wouldn't invest too heavy, but I would definitely have some exposure. I personally do. And that's what we're seeing for this one. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks have earnings that we should take a look at. I know PayPal just reported, and I'd like to look into those. And subscribe so you can stay up to date with everything. And I'll catch you next time.